Okay, so let's go here. This is for Greg G. Finally, getting to Greg G here. Looking for risk-free trade. Is there such a thing? Usually not off the bat, no. Forward conversions ROI is currently so low, it doesn't make any sense. Most time a conversion or reversal doesn't make any sense for a retail investor, Greg. It really doesn't. Any thoughts, suggestions, or ideas? Well, we already heard us talk about the limited risk trades that we do that are not no risk trades, but they start off with a 5% risk with time on your side, and then you can manage it, hopefully, to get to that bulletproof status with the married puts. A conversion, for those of you that don't know and aren't familiar with a conversion is a type of collar where I'm going to buy the stock, sell an at the money call, and typically buy the same strike put, maybe for a credit, maybe for a debit. It is a straight line profit and loss chart. Where's my default? There it is. I'm sorry. I'm looking right at it. So I have a default on power options and long collars to find conversion trades. And it's going further out, 5 to 55 days. Some investors I talk to go out about 90 to 120 days to get the better prices. So yeah, best one right now is Teleria that came up on our screen. It's a $7.98 stock, selling the October 7.5 call for 90, buying the October 7.5 put for 40. So you get 50-cent premium. Cost basis drops to $7.48. But what happens? If the stock's above 750, you get assigned. You make 2 cents on your cost basis, or a 0.3% profit. If the stock falls and is below 750, the call expires, you exercise your put, you get 750 back, you make 2 cents. It's a straight line, sorry folks, profit and loss chart. There we go. At expiration, whatever happens, we're going to make 2 cents. Now, giving me midpoint here, it gave me a little bit better at midpoint, but because those prices look, yeah, it's probably not going to gain 93. It's probably going to be 92 here, and let's say that I could get it down to 38. Oh, that might be fair. It might be give us 6 cents, a little bit better. So maybe possible, but again, it's $6. So how many hundreds of shares, and this is luckily a low price stock, how many hundreds of shares you have to buy to make this 6 cents? Not $6, it's 6 cents per contract. How many shares do you have to buy to cover commissions on a three-legged trade? Okay. Well, someone says, can't you do the synthetic? Not really. Okay, what do I mean by that? Well, this is a collar. I buy the stock, sell the call, buy the put, but I'm doing it the same strike and same expiration, so we get that straight line profit and loss chart. Negative maximum risk from the beginning. Now, the synthetic would be what? Well, I buy a call and sell a put, typically at the money. I can't do that. I can't do the synthetic because if I buy the October 750 call, it's just going to cancel the option I just sold. And if I sell the 750 put, that's just going to cancel the buy order here, so I'm just going to be left with nothing. Okay, that would be just legging out of this. Right? You can't do the synthetic unless you find different strikes. Something that maybe has a 50-cent strike difference, you sort of tweak it that way, and that gets really confusing really fast. I knew an investor years ago using power options who what he was doing would maybe enter this part of the collar or the conversion in one account, which would require a lot of margin because he's got a naked call. Then on the other side, in his other account, he'd do the opposite transactions to have sort of the synthetic stock in account A with the synthetic conversion legs in B, but huge amounts of margin to cover the naked put on that side and the naked call on this side. I didn't think that was worth it at all exposure-wise. On average, the accounts would clear out just like it was a synthetic conversion, but yeah. I would never advise this, but you could also look at the opposite. We could go to other strategies here. We could add in short collar. It's not my particular thing. This is where you short stock, sell the put, and buy the call. Right? It's a bearish standard collar, set up the standard way, just reversed of the normal collar. But the reversals might give you a little bit more premium if you get midpoint. Okay? And that's tough. I mean, some of these numbers I can already see it's going to be pretty tough to get that range there. So I'm shorting the stock like Tilray, for example, which Sam has commented on. The marijuana stocks look like they're coming back. Tilray, CGC, a couple of others there. But I'm shorting the stock, buying the call for protection the upside, and selling the put for premium. See some debits in here. That's perfectly fine. But there's more of a return here at the midpoint. And that might be what you're butting against. Okay, is that the market right now is pushing the put side with the higher premiums, aka why is the risk look higher? And we talked about the married put going back to our previous discussion. And it's because maybe the call prices are a little bit lower, the put prices are a little bit higher, so when you do the short collar, you might get a little bit more bang for the buck. But again, you're shorting the stock. You've got to make sure that you're able to do that in your account, and you're covering it with these two legs. Still a straight line profit and loss chart, just a different view. Okay, so that's going to cover this question here, and that was Greg, I believe, correct? And I think I saw another comment down here. 305 put. Oh, Sam's on SPY. He's talking about the 305 puts he bought for next week. He's expecting a slow decline in that case. Okay, let's see here. Okay, Sam bought UVXY at 25.60 and 26.70. That's his hedge for his portfolio, the volatility sort of ETF. I did buy VIX calls again as well. Okay, all right. All right, so going back to another comment from Greg that came in later. He said, you mentioned that you display the bid and ask. Yeah, I don't have it here. Where were we looking at bid and ask? Was it in my bull puts? Not on this account, but yeah. So let me add remove columns real quick, Greg. So you just click add remove columns. Is it down lower? Yeah. I want the long option bid, and then I can, yeah, long option bid, short option bid and ask spread, short option ask price as well. So, and then I can customize that. Excuse me, Greg. I apologize. There we go. Change the column order. Once I've selected, I want the short ask price next to the bid price, and the long next to that. Submit and save. Close window. Okay. Yeah, so there you go. So there, I'm displaying the bid ask. Oh, yeah, that first one is huge. The Tesla. Oh, Tesla popped up in the list now. It's interesting. Broadcom's not too bad of a bid-ask spread at all. Neither is that one. Okay. But Greg, you had said, you mentioned that you display bid and ask. Is there a way to run those scans using midpoints? Most credit spreads and iron condors, when you put in this net credit, it is showing you the midpoint net credit and the return at midpoint. Okay, so you're searching for that already. Very helpful for the iron condors on SPX and SPY, and the iron condors should be using the midpoint as well. It doesn't say that on the net credit, but I'm pretty sure that is what it's using, Greg, for that as well. Okay, Jerry. Oh, okay, that's the end of that. Jerry has two questions here. One I don't think I can answer during this webinar, Jerry. Let's risk to make money. Okay, I'm sorry, Sam, you had made a comment. It was probably in relation to that as well. You had just said no need to risk money. It could be low risk or high risk. You cannot get rid of risk. Yeah. Inside a bull put spread, I think we were talking about the 70% probability there as well. Oh, and you don't do the good call. You don't do the call side, Sam, selling the calls against those triangles. You just use the put. Okay, so where's Jerry's question? Okay, here we go. Sorry, folks. All right. Going back to sort of the married puts and the income. Did I take married put out? Oh, that was silly of me. I thought I had taken something else out. Okay, let's just add married puts back in. There we go. Okay. Let's see. All right, married put. Jerry, later on, you're going to have to tell me if you're receiving my emails. Okay, I already talked about that. So I think, Jerry, you had asked this question via email, I thought, and I had answered it in relation. So he's talking about the blueprint, and he says, in the blueprint example shows a bear call with a short call below the current price, and time is out 65 days. In other videos, overview with the income method with a short call above the current price time is only 15 days. Which way would you recommend? That's up to you. Okay, I can't answer this question. So he's talking about the application of the income methods. Remember, the original blueprint was written by Kurt, way back, and when we first partnered up with Kurt, we made a lot of changes and updated a lot of the trades, and that was in 2007, 2008. What was missing in 2000, and Ernie has gone back in and updated a lot more of the examples as well. But what was missing in 2007 and 2008? Weeklies, single dollar strike differences, and more. Okay, the different options are available now. Different markets are available. The income method that was shown in the blueprint by Kurt's original example, the 30-day didn't make sense, so we owned at 65. Why? Because that's all he had available. There were no weeklies on the 500, 600 stocks that offer weeklies or things along those lines. They just weren't there. When you see me in a video, you see me talk about combination trades, I will show one. But I'm going to give you a little teaser right here. And Jerry, you go on to this idea that income method number 6 is a riskless spread trade in the married put structure. It's a bear call credit spread, but done in the structure of a married put. Your broker just sees it as a covered call with an extra long call that doesn't cap the upside like selling a call would. You still have unlimited upside. You generate a premium to reduce the risk. So with that in mind, Jerry says, in addition to that, what's the best way to do it? I'm going to talk about that in a second. And you also said, I apologize, what probability should I look for income method number 6 since it's a bear call? Ignore probability completely, Jerry. Don't even take that into account when you're doing it in the context of a married put. When we talk about a bear call spread or a bull put spread, we're talking about a spread position where we want to set up the structure to be successful long-term on the structure by itself. I need an 85% probability. I need to be right 83% of the time long-term, targeting an average of a 15% gain on winners and 48% on the losers, even in the black swan events. I might just close them out when they hit 48% of the maximum loss, which is the difference in the strike prices. That probability you hear discussed is solely related to being successful with just this strategy, or just the bear call strategy, which wasn't successful with those numbers in 2008. I didn't trade them, but every test I ran, every historical test we did for the entire 2018 year, with probabilities at 80, 83% on stocks that were bearish, on stocks that had bearish trends, on stocks that were bullish that showed weakness, on stocks that were hitting new highs that you might expect to fall, every bear call, 26, 27 iterations of different criteria with 80, 85, even 90% probability failed, lost money. And it's because of what we already saw during that course of the year. That's not related to this, but the idea is that probability discussion, Jerry, is just to be successful with this portion of my portfolio that's applying this particular strategy. If you're in a married put, you don't need to pay attention to probability at all when talking about income method number 6. Who's up today? Citigroup. Okay, taking a profit and loss chart here. That's showing me the 75. It's up $1 or so today. So here's what I'm going to do. I'm going to say that I actually got into Citi at 68.50 a few days ago, maybe 2 weeks ago. And at the time, I'm sorry, folks. At the time, I probably would have gotten into the March. And I probably would have bought the 72.50. Where are we at today? Oh, 70.39. Okay, so let me clear that out. Let me use the 70. I'm cheating. Let me cheat. Let's say we got in at 67.50. And we bought the March 70 put at that time for about 610. Okay? I'm going to increase it to 640, 650. Okay, let's get our risk to right around 5%. Okay, so here I am. Stock is above my put strike price in this case because I went with the 70. Okay, even if it was the 72.50. And now I want to do a bear call spread. Well, the stock's above 70.39. So I'm going to be honest with you. And I might have Ernie or Kurt change that. But I'm not going to sell the 70 call. No way. No, I still want some upside. So I'm going to focus probably on, I'm going to go 72, 74. Okay, I'm still going to do one rule. I'm going to apply one rule to my income method number 6 position. That's going to be my income method number 6. It's going to be a bear call spread, but done in the context of the married put. But I'm going to follow what I do for bull puts and bear calls. I'm going to keep it at least a 2-point spread, because through testing I found that works better than the 1-point spreads in everything I've done and all the testing that we've done. Ernie's saw that too. Okay, why the 72? Why not the 71? Well, I still want to give it some upside room. All right, and here we're going to get 55 cents, and we're going to pay about 20 cents. So I'm going to have 35-cent net credit. Now, if I did the 71 and the 72, I'd probably get a 40-cent net credit. It would be higher. But again, what is the goal of income method number 6? The goal is to generate enough credit to make a reasonable reduction in the risk and to give me a little bump heartbeat in the profit and loss chart. So I could go to the 74-76 spread. Okay, what would that do? That would have only dropped this about my risk by about 0.3, 0.4%, would have only been 10 or 15 cents. I could go to the 78.80. Well, that would have been 5 cents, if anything. It's not worth it. Okay, we talked about the 72.74, but the possibility there is we would have reduced the risk more, gone up, come back down, and done this. What I'm looking for is to be usually a little bit out of the money, not related to probability, not related to delta, just considering the stock price as a general rule. I never want to see a chart where it goes below. I never want to see a chart that dips too low when it's here. I want to still have about just as much profit as this point if I liquidated the position right now, a little bit more here with the infinite upside. But again, the credit also has to be the reduction that matches the discussion that's in there in the blueprint as well. Okay? Is there anything wrong if it's available? And it's probably not. Is there anything wrong instead of taking that 40-cent net credit we just saw versus going out to standard October 35 days away and doing a 72.50, 75 where I'm going to get maybe 70 cents? Okay, so we're doing a bear call at 72.75 in the context of the married put, which just looks like a covered call with an extra long call, so the upside is open. I reduce the risk to 4.5%. Okay, I get a higher net credit. But as Sam mentioned earlier, based on the time frame, we were looking at 40 cents for 15 days versus 70 cents for 35. Okay, so double the time, did I get 2x the credit? But if this 70 cents matches more of the total reduction you wanted in the risk, and you're comfortable with this chart because it doesn't dip down into the second level, then you could consider this. Again, why wouldn't I take the best premium shorter term in that case and go with, say, the 71, the 14 days out again, keep the shorter term, but go with the 70 that's slightly in the money at $1.50, and let's say even go out to the 72 at 55 cents to get almost $1. Well, it's because it's already in the money, right? When I do that income method, I'm not saying I want to get assigned. I'm just sorry, folks. I'm comfortable if it gets assigned. And those of you who have the blueprint, you know what I mean. Okay, so this one here is a good premium, but look, if it goes up to here, the max profit's only 62 cents. We were looking at 120, 160 with the other two spreads that were further out. Yes, you reduced the risk more, but the peak here is only at 145. On those other two spreads, the 14-day out of the money, 72, 74, this was at 145 at this point at the long call strike. I'm sorry, it was 126 and then 160 going out to October. We're just barely there at the short strike peak. And yes, you still have infinite upside in both cases. Here you did reduce the risk more. I know that's a lot to take in, Jerome, but do you see what I'm saying? This is coming down to you. Okay, this is the application of what we call the SIGA model in every one of those income method chapters of the blueprint. What is more important to you? reducing risk or enhancing upside profit. If it's reducing risk, this might be what you'd want to do. Closer to at the money, get the better premium. But remember, you're already in the money on this call, which means you're either going to have to, if it stays up as you expect, you're going to have to buy to close it, even if it's between the strike prices, which is going to add to the cost basis of the position, which increases the risk from where you are now, okay? Because you do take that premium right in. Yes, you still have the infinite upside. But if you want to keep the stock, you're going to have to do something with that short call. If it goes above both, you don't have to worry because you have the long call to get back in the stock, or your broker might just close that bear call. A little complicated at that point when we talk about closing because each broker handles it a little bit differently. All right? But it's your goals for the position, the G and the SIGA model, and it's based on the expectations. If I expect the stock to move up, let's say a little bit up to 71 or 72, but then have a gradual pullback as Sam selected, I'm probably sticking with a 72, 74. That's a possibility. And if it matches what I wanted to reduce the risk by the percentage I look for as well. And you don't have to do a 2-point spread. You could do a 4-point spread. You could do a 3-point spread. You could do a 5-point spread if you wanted to, because you don't have to put up the margin. That's the great thing. And doing the wider spread, what does it do? Well, it gives you a higher net credit, but what you're also going to do is have more of this. So if you did the 70-75, it'd look like that because you increased that strike range. So I like to keep it around 2 strikes on these single strike options, going 14 days out or so. If it matches my credit requirement of how much it's going to reduce the risk, and I'm going to shoot for about a 1%er. Okay, I want to see the risk reduced by 1%. That's personal. Doesn't have to be your numbers, Jerome. That's mine. All right. So you know, your question is which is better? Well, that depends on your SIGA model, the current conditions, your expectations, goals for applying that income method, and that determines your action. You never want to do an income method number 6 where the graph dips back down into the red. That is an improper structure. It's not about probability. It's about being a strike or 2 out of the money, getting a reasonable premium around 1% of the risk that you have remaining. That should get you the proper structure that you want with still the good reasonable return even at that level, a little peak here, and the unlimited upside going forward. And I'm sorry, I mean, I could look at it right now and say, okay, well, I said that I'd prefer to do this one. In this situation, if I had this gain in the stock, it's moved up about 3 points from where I got in. It's just above my current put strike price. Going back to September, 72.74 for about a 40-cent net credit or so, a little bit more than a 40-cent net credit. Actually, wait, let me make sure I'm even in my range there first. Yep, not quite where I wanted. You're right, it's not quite where I wanted. I apologize. That's about a 0.5% reduction in risk. I'd want it to be closer to 1%. So I started this Mary put with a 5.4%. This, as we saw, dropped me down to 4.9. Yeah, 4.9. So this is only a 0.5% reduction. To be honest, Jerry, I don't know if I would do this one now. This gives me the graph I want. This looks like the structure that I want in this case, but it only reduced my risk by 0.5. What I'd be tempted to do here, and just throw it out there, those of you that don't own the blueprint don't know what might not know what I'm talking about, but since it's here, I'm probably moving the put up to the 72.5 and then looking for perhaps 73.74 spread, or 73.75 spread, excuse me, that's 20 to 28 days out in time. If I do that first, if I did income method number 4 first, okay? All right, so, but it's based on your structure. You just want to make sure you have the solid structure in place, okay? You want the graph that looks like this. Oh, sorry, where I was going with that is 14 days out, 72 strike call. Let's go to the option research tool. Okay, so this is a 68.7% probability with a 0.32 delta. I'm just showing you this because the next income method number 6 I use, it looks right to me, could be a probability of 64.6% with a delta of 0.38. The next one I use could have a 75% probability with a delta of 0.26. Okay? I don't look at that at all when doing this. That's not what I'm looking for. What I'm looking for is a good strike or two out of the money, spread 2.5, maybe 5 points apart, if and only if this what-if scenario matches what I want to see for this, and the risk reduction is at least 1%. That's personal. 0.5%, to be honest with you, isn't bad. Not bad to get 40 cents for a good 14 days, 0.5% in this case against the Marriott put risk, leaving infinite upside. Not too bad at all, but I don't think this one matches my targets. But that's what you see. What's the benefit of selling it closer to the stock price? Higher net credit, perhaps. What's the downfall? Well, you're going to have a lower peak. You might dip that down in the red, and then you still have infinite upside, sure. But you lower the risk more. Everything is a trade-off, isn't it? This might have given me a risk down to, as we saw, I think it was 4.1% if I sold the 70 and bought the 73 or the 74. Okay? But again, the chart didn't match what I want. And, if you go too far out, it's not worth it, right? If I went to the 76, 78 on this expiration cycle, sure, the chart would have me, way up here, for example, and doing kind of this thing, which would be higher profit here and higher profit here, but I've only taken the risk down to about 5.3%, probably about 0.2. It would have been a 10-cent, 5-cent net credit. Definitely not worth it. So that's the trade-off. Keeping it close. Remember, you're at the money bell curve. You want to be selling closer to this at the money range and buying in this range. Okay, that's why we buy the puts out here. But in this case, yeah, I'm selling sort of over here on the short call, and I'm buying over here on the long call. Okay, I'm keeping that sort of in that pace to stay true, to the ATM bell curve and the 3 core principles of radioactive trading, which is really the 3 core principles of any options trading strategy. Okay, let me go back here real quick. Review. Sam says that he likes the bull puts even when the market is coming in short, coming near his short, because he'll buy the shorts and buy more puts to profit. Yeah, it's a different way of rolling the positions. He says, why Apple dropped this morning, it was in the news. He was in a bull put in Apple and did a call credit. It was falling at 225, 230. Did not hold this call spread for next week. I took my profit on that position and made about 12%. Okay. I think you're saying on the call side you just made 12%, right? Oh, you sold out of gold. I'm sorry, you sold out of gold and made 12%. Okay, fantastic, fantastic. Okay, well, Jerry, I hope that sort of cleared some things up for you in relation to income method number 6. Again, something that we don't typically show for the non-blueprint owners that might be online here, as it kind of might just be confusing for them. But that's what you want to look for. Okay, there's no one criteria. You really want to focus on what is the credit, and is it reducing your risk by a reasonable amount by the credit you're taking in? Are you giving yourself enough upside in that case, so if it moves up to the short call, you're not cutting it short too slow or too soon, and you never want to see that second leg end up back in the red into a loss. That's an improper way to do income method number 6. So it's more about the goals, the expectations, and the what-if scenario, as opposed to what delta should my short call be in the income method number 6, what probability should I be looking for with income method number 6. It's going to differ from stock to stock and your cost basis and where the stock is in relation to your put and what strikes are available. You want to look for the chart that matches those goals with about a 1% reduction in your risk. Okay? All right. Well, I don't see any other question comes in. Sam did correct me, I'm sorry. He says he made 70% on his Apple calls, it looks like, when he closed out of those positions, and it was the 12% on the gold. And he had mentioned he had bought UVXY as well. I think I already talked about that. So he bought into UVXY, and yeah, I got into VIX calls when I saw it hit that 1360, 1370 level. So I think I bought 17 straight calls that are out past September. All right, so I don't see any more questions that have come in. I do want to thank everyone, of course, for your great conversation. As I mentioned, I will try to get this converted, cut up a little bit for you, and start posting some of the sections of our conversation this weekend. I do want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investment performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I'm not saying it's a great idea to go out and look at those reversals, the same strike short collars, because the conversions aren't paying enough. Because personally, I don't get into the shorting the stock routine or doing it in that structure anyway. We just saw that if you got filled at midpoint, there might be higher returns. But I'm not advocating that you should go out and do short collars right now, conversions or reversals. I may open a married put and ally, or post a married put for ally, I should say, for our Fusion subscribers next week. But hey, that's been protected with a put option, so I'm not too concerned about that being considered advice. It's going to be a low-risk trade, around 5% in the worst-case scenario. But options do involve risk. They may not be suitable for all investors, and of course, we've all seen why. Now, today we did have a chance to show the power of using the search tool to put in specifically what you wanted to see for settings, and we focused on the married put. We also showed how you could customize the columns to match what data you wanted to see. We looked at that with Greg for the bull put credit spread and adding in the bid-ask spread and seeing the search at midpoint. We showed the what-if scenarios, showed the research tool on the stock and on the options as well. So many of these tools look like they're going to match your needs, which they probably will, to help you save time with your options research and analysis. And we got big into the probability, I should mention too, of course, in the iron condors there. But again, these tools are a great way to help you save time with your options research and analysis. And you can take a trial at any time if you haven't done so already. Just go to powerop.com, put in your name and email address, and you'll have full access for 14 days. After that 14-day free trial, subscriptions start at $45 a month for end-of-day data. We have other different data streams, not data streams, but services available with 20-minute delayed data or even real-time as well. You'll see that on the subscription page. We talked about the portfolios, some that were available for the description, I think, into the success rate of the lower probability bull put credit spreads over the same time horizon as the higher probability, and why the higher probabilities worked. You can see more of that information at the webinars page, powerup.com/webinars.asp. It's under the option strategy section. Also articles there on the blog, and of course you can always check us out on YouTube, where all of our Friday discussions are posted as either one large webinar or as multiple sections of smaller digestible nuggets. Okay, and as always, if you think of any follow-up questions, or you have a question that you didn't get to ask today, it didn't come through, looks like I've answered all the questions, or you have a comment about today's discussion and what was presented, send me an email at any time to support@powerup.com or support@radioactivetrading.com. You can also reach us during market hours at the office at 302-992-7971, and any trial member or subscriber can schedule a coaching session, which is essentially a 45-minute conversation with myself or Ernie. We'll walk you through the tools on the site, answer any options investing questions that you have as well. Well, thank you again. Happy, safe, non-spooky Friday the 13th to you all. Thank you for all your questions. Sam, thank you. You have a great weekend as well, and relax. And we'll see you all next week for next one or two of our presentations coming up. So take care, everyone. Good night.